Once upon a time, many believed that cryptocurrency was the future of finance. Today, however, it's becoming clear that crypto will just be one niche in a broader ecosystem of digital assets. And it looks like this ecosystem will be dominated by tokenized real-world assets. But most people don't understand what they are, how they work, or why they're so significant.
How significant?
And that's why today we're going to tell you everything you need to know about tokenized real-world assets, including how they work and which ones to watch out for. My name is Nick, and this is a video you can't afford to miss. I'll start by saying that nothing in this video is financial advice. It's educational content intended to inform you about tokenized real-world assets. If this is the kind of content that you like, well, prove it by pounding that like button, and let's get started. Now, the easiest way to understand tokenized real-world assets is to understand how asset issuance and trading currently work. Imagine you want to issue a stock in the US. To do this, you need an underwriter like an investment bank, who will buy your shares and sell them to investors on your behalf. You need an auditor to check your financial statements, and you need lawyers to file with the SEC. Assuming your application is all good, the SEC will give you the permission to issue your stock, and by that point, you've typically found stock exchanges that are willing to list it. Once the stock has been listed, there's a whole new architecture of intermediaries facilitating the trading of your stock. First, there are the broker-dealers, which execute the trades on behalf of the investors, and they do this on the stock exchange. The stock exchange matches the buyers and the sellers of your stock, and then the clearing agency will check to make sure that the stock was actually bought and sold. After that, the clearing agency will settle the trade, which typically takes around 1 day. There's also a whole bunch of other counterparties tracking the change in ownership, like transfer agents and others overseeing the trading process like regulators. Now, suppose you want to issue a tokenized real-world asset, which we'll refer to as RWAs for the remainder of this video. At the time of shooting, there technically aren't any established regulations for the issuance and trading of RWAs, at least in the United States. However, current RWA proposals by the SEC and pending crypto regulation like the Clarity Act give us a sense of what final regulations will look like. In short, it looks like the main and possibly only requirement for issuing certain types of RWAs will be basic disclosures like who is issuing it, where they're based, how much of the RWA there is, whether the supply can be changed, who holds the initial supply, and so on and so on. In practical terms, then, all you would need to issue an RWA would be just to fill out a few forms for the SEC. At that stage, you would issue your RWA on a blockchain, which can be simply understood as a shared database like a Google Drive. The difference between blockchains and shared databases like Google Drive is that all changes to the blockchain need to be approved by the participants connected to it, whereas on a shared databases, you don't need consensus for any changes. In case you didn't notice, the reason why asset issuance and trading for stocks involves so many intermediaries is precisely because they're all checking to make sure that any changes are valid. For instance, entities like the underwriter and the regulator check to see that the stock is legit, whereas the broker-dealers and clearinghouses ensure that every trade of the stock is legit. As you might have guessed, most of this can be automated using the blockchain. For instance, the blockchain could be designed so that the SEC can give permission for an RWA token to be minted once they've checked the disclosure documents. And when it comes to trading, all of the participants connected to the blockchain can easily verify when an RWA has been traded or moved. And this means that you don't need all these intermediaries like broker-dealers and clearinghouses. Depending on how and where the RWA is issued, you may not need anything else except a bit of capital to kickstart trading for your RWA. As a fun fact, this is basically how new token issuances work today in crypto. You just need to fill out a few fields, provide some capital, and voila, you've launched a new token. The difference is that crypto tokens usually aren't backed by anything, whereas RWAs are almost always backed by an equivalent amount of assets held in custody somewhere, be they stocks, bonds, or currencies. Some would argue that these assets aren't always backed either, and it becomes even more complicated when RWAs start to be issued natively, but we'll come back to that a bit later. So, to quickly recap, issuing and trading assets like stocks currently involves a lengthy process with over a dozen counterparties and intermediaries. Issuing and trading RWAs is much faster and more efficient, since the jobs done by most of these counterparties can essentially be automated away using a blockchain, which is a shared database where participants can see and agree on all changes to RWAs. With that in mind, we can take a closer look at the blockchain technology that powers RWAs. If blockchains are like shared databases, then you can think of RWAs as being files on that shared database, with each folder belonging to a different user. And these files can be created, destroyed, traded, lent, borrowed, and used as collateral. But again, all changes must be approved by the participants. Who the participants are depends on the type of blockchain. As a rule of thumb, there are two types of blockchains: permissioned blockchains and permissionless blockchains. As the name would suggest, permissioned blockchains are blockchains that you can only use if you're given permission. Participants on permissioned blockchains tend to be megabanks and asset managers which manage these permissions. The primary advantage of permissioned blockchains is, well, these permissions. By controlling who can use the blockchain and how RWAs can be issued and traded, it makes it possible to have a digital asset ecosystem that's fully compliant with existing regulations. This control component is also why permissioned blockchains are seen as dystopian. All your assets are closely surveilled and controlled. The trade-off is money. The more compliant a permissioned blockchain is, the more comfortable investors will feel depositing money into its ecosystem. And this is worth keeping in mind, because it's possible that the next speculative wave in digital assets will take place on permissioned rather than permissionless blockchains, simply because that's where most of the money will flow in the future. By contrast, permissionless blockchains are blockchains that you can use so long as you have an internet connection. Participants can be almost anyone, so long as they meet the requirements to become a participant. For proof-of-work blockchains, that means having enough computing power, and for proof-of-stake blockchains, that means having enough of the underlying coin to stake. As a fun fact, the whole reason why consensus mechanisms like proof-of-work and proof-of-stake exist is so that unrelated parties with no affiliation or legal recourse can agree on changes to the blockchain. These mechanisms aren't required on permissioned blockchains because participants tend to be financial institutions with close affiliations or legal agreements. Now, in case it wasn't clear enough, you don't need permission to access a permissionless blockchain. The other participants won't stop you from issuing or trading tokens on it. And as you might have gathered, most cryptocurrency blockchains are permissionless. And yes, that's the primary advantage. Anyone can use them, build on them, and participate. But there are trade-offs. The first is that you're completely on your own when you use a permissionless blockchain. If you lose access to your wallet or someone steals your tokens, you can't get them back, unless it's an RWA, but we'll come back to that a bit later. The second trade-off is the fact that large pools of capital don't feel comfortable using permissionless blockchains, and this means that we're unlikely to see large amounts of RWAs issued on permissionless blockchains in the long term, unless these blockchains start introducing permissioned features. And this might sound crazy because right now, most RWAs actually exist on crypto blockchains. According to RWA.xyz, there are over $20 billion in RWAs on crypto chains, and that jumps to over $320 billion if you include stablecoins. This is impressive, especially when you consider that most have been issued by TradFi institutions. The catch is that most of these RWAs can't be freely transferred for compliance reasons, and the caveat is that these institutions are likely just testing RWA functionality on permissionless blockchains to help improve their own permissioned systems. So, to quickly recap, RWAs exist on two types of blockchains: permissioned blockchains run by TradFi institutions and permissionless blockchains run by crypto miners or validators. Right now, most RWAs exist on permissionless blockchains, but in the future, they'll likely move to permissioned ones since large pools of capital require more compliance. With that in mind, we can take a closer look at the RWAs themselves. And this is where things get interesting, but also complicated. So, listen closely. As with blockchains, there are two types of RWAs, and what's interesting is that nobody has realized this yet. So, terms don't exist, and we'll refer to them as native RWAs and non-native RWAs. Native RWAs are those which technically don't have any real-world assets backing them. Exodus is a perfect example. For context, Exodus is a crypto wallet company that issued its stock as an RWA. In other words, there is no physical stock backing it. It was originally issued as an RWA on a blockchain, and this RWA was then used to back the stock which now trades on Nasdaq. Another example of a native RWA is any central bank digital currency or CBDC issued on a blockchain. And that's because a CBDC technically isn't backed by anything, just the power of the central bank, which depends on the military and economic power of the country in question. In any case, the fact that it's issued natively without physical cash means it's technically a native RWA. By contrast, non-native RWAs are those which do have real-world assets backing them. X stocks is a perfect example. They're backed one-to-one by the stocks they represent. The catch is that holding X stocks does not give holders legal or voting rights, and the caveat is that only select institutions can issue and redeem them for the underlying stocks. Another example of non-native RWAs are tokenized gold tokens like PAXG and XAUT. Both are backed by physical gold held in vaults, and unlike X stocks, they grant redemption rights for the gold if conditions are met. The fact that gold is elsewhere means the RWA is not technically native. Now, right now, most RWAs are non-native, but in the future, they'll likely be primarily native, assuming most assets become tokenized. And that's because stocks, bonds, and currencies make up most of global assets, and they could all be issued as native RWAs. Obviously, physical assets like real estate and precious metals will continue being non-native RWAs. And of course, the issuance of new native RWAs is likely to result in lots of opportunity. And if you want to make sure you're ready when the next speculative wave comes in, then you have to check out the CoinBureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges which have RWAs. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you're on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals won't be around forever, so take advantage of them ASAP using the link down below or by scanning the QR code. Back to the video. Now, this brings me to the big question. Which RWAs should you be on the lookout for? And if you've been paying attention, you'll know that the answer starts with understanding where to look. In the short term, the RWAs with the most potential are likely to be non-native RWAs on permissionless blockchains, mostly precious metals and stocks you can trade on crypto chains. That said, this fundamentally depends on what happens with regulations in the short term. The SEC is looking into giving exemptions to many on-chain activities, including RWA issuance and trading. If these exemptions arrive soon, we could see a wave of native RWAs being issued on all blockchains, kind of like the ICO boom of 2017, but slightly more legit. In the long term, the RWAs with the most potential are likely to be native RWAs on permissioned blockchains. And this again depends on what happens with regulations by then. It's too soon to say what these will look like, as it partly depends on what happens with RWAs today. Any systemic issues or bubbles now could lead to stricter regulations later. But that said, there's another fascinating nuance to RWAs that almost nobody has noticed. There's an incentive for governments around the world to create as much speculation in RWAs as they possibly can. And that's because most RWAs won't be purchased using regular fiat currencies. They'll be purchased using stablecoins, which are backed by the debts of their respective countries. In case you missed it, most countries have been issuing enormous amounts of debt, so much so they're running out of buyers. And this has led to unconventional and counterproductive methods to raise money, such as tariffs. RWAs provide a subtle solution. They practically force investors to purchase a country's debt to access its financial markets. This is a powerful tool for countries like the United States because many wealthy foreigners save in US dollars or US denominated assets. If all those assets become RWAs, then foreigners will need to buy stablecoins to buy US stocks, and the effect is that US bonds will be bought behind the scenes to back these stablecoins, subsidizing US government spending in the process. And this isn't speculation either. The CFTC is already considering allowing stablecoins to be used as collateral in TradFi derivatives trading, and that means stablecoins could soon be used to go long or short US stocks. Given that derivatives trading is the biggest demand driver for stablecoins in crypto, all that speculation would end up subsidizing US spending. And that is a long-winded way of saying as more RWAs emerge, the market cap of stablecoins will grow. Logically then, you should be on the lookout to see which stablecoin issuers will benefit most from these RWA dynamics. And the one that comes to mind is Circle, which not only has a tradable stock, but also has close connections to BlackRock. And these issuers could become the new blue-chip companies in a tokenized financial system with more speculative RWAs as the growth frontier. And that reminds me, the main kinds of RWAs to watch out for are those backed by historically illiquid assets, such as real estate. And that's because increased liquidity leads to more price discovery, and where there's volatility, there's opportunity. In sum then, which kinds of RWAs have the most potential and where you'll find them depends on regulations in the short and long term. Stablecoin issuers will be the biggest beneficiaries of RWAs, while RWAs that unlock liquidity in illiquid assets will offer the greatest upside. So, keep your eyes peeled. And if you're not subscribed to the channel yet, you can do that right over here. This is Nick signing off. Thank you guys very much for watching, and I will see you guys again soon.
Hey folks, before you go, I have a special announcement to make. If you enjoy the macro-focused content that we post here on Coin Bureau, then good news, you can now watch it on its own dedicated channel, Coin Bureau Finance. So, from now on, we'll be posting our non-crypto content on this new channel that's focused on all aspects of modern finance and investing, while keeping this channel dedicated entirely to crypto. And you can learn more about Coin Bureau Finance in this video here, and you can subscribe to the channel down here. Thanks in advance for your support.